Hello everyone. Welcome to another QuantInsti webinar. This is your host Kshitij Maurya, and today we have a session on factor investing with algorithmic trading. Now, this session will be conducted by Rekit Pachanikar, who is a senior quant associate at QuantInsti. Let me introduce to Rekit. Uh, a fascinating individual with a strong passion for all things tech and finance. After completing his engineering in computer science, he pursued post-graduation in management from IIM Indore. Now, Rekit is part of the content team at Contra by QuantInsti, where he delves into researching equities and fixed income securities. Away from work, Rekit loves to read up on the outliers in the market, and when it comes to Tesla, he is an avid follower with an eagle eye for all the latest updates. Hi, Rekit. Welcome to another QuantInsti webinar. How are you doing today?
Hi, Kshitij. Thank you for the warm welcome. Yeah, I'm doing fine. How are you?
I'm doing great. This is our back-to-back second webinar. The previous webinar was also
Right.
conducted by you. So again, thanks for taking out your time and joining us here today. Uh, yeah, before we start with today's session, please note that we will be answering all your questions at the end of the presentation. So please make sure that you ask all your doubts in the questions panel. And also, this session will be recorded and uploaded on QuantInsti's YouTube channel. So make sure that you subscribe to our YouTube channel and get access to all our latest videos, including this webinar, also the previous webinars. And also there are so many other tutorials out there which we keep on posting on various trading strategies and various algorithmic and quantitative trading concepts. I have shared the link of the YouTube channel in the chat, so you can check it out. And with that said, let's straight dive into today's learning session. So, Rikit, the stage is yours.
All right. Thanks, Kshitij. And hello and welcome to this webinar on factor investing with algo trading. Now, before we start this learning session, I just want to give a small disclaimer that the information provided in this webinar is for educational purposes only and not financial advice. So, whatever examples which are given here, they are not to be taken at face value, and obviously you should always backtest any strategy idea of yours, and only when you're confident, move ahead and live trade. So yeah, that is just a simple word of advice we like to give. Now, as Kshitij mentioned, I'm your host Rekit, and I've been with QuantInsti for quite some time. Now, QuantInsti started off with EPAT, which is a 6 month long course where we teach the A to Z of algo trading with live lectures and support managers who guide you through the program. Now, for traders and other students as well who want to study certain topics, we have Quantra, which hosts self-paced courses. And we also have Blue Shift, which is our research and trading platform where you can backtest and live trade various strategies. We have catered to users from 190 plus countries, and around 3 million hours of content has been consumed annually from our platforms. Now, having said that, whenever you start any endeavor, be it any course, even a small video, educational video, whatever you are consuming, you should always ask the question, what's in it for me, right? So, having said that, let's go through the agenda for today. First, we will look at the factor investing principles, something which every factor investor looks at before trading. We'll also have a brief understanding of algorithmic trading and what exactly the process is. Further, you'll also have the factor investing strategy in the algo trading framework. And we'll also see how to build a factor-based trading model. And finally, the main part of the session, we will look at the backtesting and performance evaluation of the factor-based trading strategy. And as Kshitij has mentioned, we will have an interactive Q&A at the end of the session. All right. Now, the strategy that is being demonstrated in this session uh, gave a cumulative return of 1.42. Now, this means that you'll have actually achieved your objective of 6.7% returns by the end of the backtest period, which is received a 42% return, which is from 2nd October 2017 to 30th September 2022. Now, bear in mind that this is the basic form of the strategy and we haven't optimized it further. So that is something which I wanted to point out. Now, all right, let's start first by asking what are factors? Imagine you're driving a car on the road. Now, in this example, the road actually represents the stock market and your car represents the stock. And these factors are like the external forces that influence how you drive. Now, in this example, it could be the weather conditions, the condition of the road, and even your own driving skills. These will affect the speed of your car. So you could have a part of the road which is under construction and that might slow you down, or a highway where you can really go at a higher speed. So in that way, your progress is in some way influenced by these factors. Now, you will obviously ask, does factor investing really work? Right. So we have the stock price graph of Berkshire Hathaway Class B shares, which is managed by the legendary investors Warren Buffett and Charlie Munger. Now, these have been known as factor-based investors. And if you see the price graph, you can see that it went all the way from $117 in 2013 to $253 in 2023. So that's a three times increase in 10 years. So we believe that factor investing, if done in the right manner, can actually give you decent returns. So are these principles followed by these factor investors? Well, let's see them in the next part of the session. The first is obviously factor in identification. Now, these factors are actually some specific attributes or characteristics that have been known to be associated with outperformance with respect to the market or even risk reduction for that matter. Uh, so, common factors actually include size, momentum, and quality. Interestingly, these factors are covered in a course on Quantra, which is factor investing concepts and strategies. Now, researchers actually identify these factors by analyzing historical data and they'll try to find consistent patterns in them. So that is one of the principle of factor investing. The next is the systematic approach. Now, factor investing is systematic, which means that it relies on rule-based strategies rather than just active stock picking. So this will allow you to have a consistent and disciplined implementation of the strategy. Also, factor investing principle is diversification. Now, rather than focusing solely on individual stocks, like they say, do not put all your eggs in one basket. Factor investing actually looks at multiple stocks or multiple assets which exhibit certain factor characteristics. And this diversification will help you actually manage risk and reduce the impact of individual stock volatility. So, for example, in the value factor, you would actually look at stocks which are undervalued and not just look at just one stock. Another important principle for factor investing is long-term focus. So, if you really go into detail of all these factors, you'll find that they tend to exhibit a cyclicality, which means that in the short term, they may not be able to deliver results, but in the long term, they hold true and they are known to have consistent returns. But of course, investors should have a patient and disciplined approach when you're using a factor-based strategy. And further, these factors are actually grounded in rigorous academic research. What it means is researchers actually use historical data to identify certain factors and they will test their effectiveness in explaining the extra returns. These extra returns are in relation to the market or rather the index returns. So this empirical approach will actually help investors make informed decisions. And finally, one of the great things of a factor-based investing framework is that you can combine multiple factors. So, like I said, don't put all your eggs in one basket. You can actually combine multiple factors. And you can have a more balanced exposure and reduce the reliance of portfolios on one single factor. So, risk outlook. So, obviously, we are here to have a systematic approach to trading, right? So, this is where algorithmic trading comes in. But you must have a question: what is algo trading and why do I need it in the first place, right? So, let's try to understand the need with the help of an example. So this is a price graph of Tesla, and this is a price adjusted uh, graph. So if you have thought about it, and if you had bought a Tesla stock in 2017, it would have costed you $22. This is a adjusted close price, by the way. And by November 2021, the stock price actually has gone to $365. Now that's 15 times in almost 4 years. But here's the thing. This was just one time where the stock was trending up, right? It might have been a lucky coincidence that you had bought it at the right time. Instead, if you had suggested to a friend that, hey, like Tesla is doing really good and I got 15 times in 4 years, and that friend said, okay, we are in November 2021, let me just buy Tesla stock. So, if your friend had bought the Tesla stock in November 2021, where the price was $365, but if you see recent times, the stock actually declined and it is at $233. That's a decline of 36%. So here, a simple buy and hold approach might not work. And rather, wouldn't it be better to have certain rules for entry and exit? So this is where algo trading comes in. And algorithmic trading, to give you the standard definition, is a method of trading where we use computer programs and which will actually process this historical data, which we call market data. And based on a set of instructions, it will generate the buy or sell signals. So you'll know when to buy or when to sell. Now, obviously, you don't just depend on this computer program and you buy and sell whenever it tells you. You actually analyze it. You actually try to understand how it is working and if you can optimize it further. So this is where algorithmic trading can actually help. So let's go through the building blocks of algo trading in the next section. Now, obviously, you need data to process and to understand what is happening. So the first and foremost thing which you'll do is you'll retrieve data from a reputed data source. For example, if you were to trade in Tesla shares, you would need historical data of Tesla, right? I mean, that is a simple thing. And this can be of daily level or minute level or even tick level as well. It depends on what kind of strategy are you employing. And Once you have the data, you'll start with your analysis and you will try to establish the entry and exit rules for the strategy. Now, you can do this using machine learning, technical indicators, or as we'll see in a few moments, you can base these rules based on factors as well. Then you'll actually create an algorithm based on your analysis and also backtest it. So you can also apply certain risk management principles like adding a stop loss and take profit so that you can improve your strategy performance. And finally, once you're done with everything and you're really confident that the strategy is good and it will deliver decent returns to you, will you actually go and execute it in the live markets? So yes, these are the building blocks of algo trading. Now that we have covered what is actually algo trading and how it works, let's see a factor investing strategy in the algo trading framework. Now, in this session, we are going to use value as the factor on which the strategy is based. So, what is value? Now, suppose you're in a store looking for a loaf of bread and you see this bread by company A, which is a branded company and which sells premium quality bread at $10. And then you have company C and D, which are decent companies and which are selling their bread at $8. And you see that more or less the standard price is $8. But further down the aisle, you see there's a new company which has started producing bread, and this company G is pricing their bread at $7. Now you're intrigued and you think that, okay, you know the reason why company A is selling their product at a premium. That is because they're a premium company, right? And you know that rather you have an idea that the average price of bread should be $8, as you can see from company C and D. Then why is this company G providing bread at $7? Is it not good as company C and D's bread? So you will research and find out that it is actually a new company and which has used technology to rather streamline its operations to produce bread at a lower price. So you think that is great. I mean, they are passing on the benefit to the consumer. And further, you see that it is actually given a favorable rating from the health department. So you think that, okay, the bread is of same quality as others and at a lower price. It is good value for money, right? So this is how you actually look for a value for money product. In a similar manner, in the value factor, you are looking for stocks which are undervalued or value for money. But how do you know if a stock is a good value for money, right? This question has plagued a lot of people. And for the answer to this question, we will go to some legendary investors and try to learn something from them. So Benjamin Graham is known as the father of value investing. And later, Warren Buffett and Charlie Munger actually took these principles, they added their own interpretation to it, and looked at investing through these ideas, or rather, through these principles. So, according to value investing, it is said that among various elements, you can actually look at the financial ratios from the financial statements to identify value stocks. So Benjamin Graham said that there are certain stocks which are undervalued, but the market is somewhat ignoring it. That is why they are underpriced or available at a discount. But how do you identify these undervalued stocks? So there are a lot of financial ratios, and depending on whom you ask, everyone will give their own idea as well as their own favorite, which they swear by. But for today's session, we have narrowed it down to two financial ratios, which are the price to earnings ratio, and the price to book ratio. So the PE or price to earnings ratio is simply the stock price of the asset divided by the earnings per share or the EPS of the company. Great. Great. Sounds simple enough, right? In a similar manner, the price to book ratio or P to B ratio is is the stock price upon the book value per share. Now, to make sure that this session doesn't go for multiple hours, I'm not going to go into detail of how these ratios are calculated, but this is the formula for them. And you can calculate them using the data retrieved from financial statements, which are released by listed companies. And it is mentioned in research that a company which has a lower P ratio or a lower PB ratio is an undervalued stock in comparison to others. And you should buy these stocks according to the value factor. So I'll take a brief pause over here for you to assimilate the knowledge which you have received till now. All right. So now we have identified maybe the undervalued stocks. What next? So, in simple terms, the strategy would be if you have 100 stocks in your potential universe, you'll calculate the P ratio and then select the stock which has the lowest P ratio. And this stock will be the most undervalued stock from your basket of 100 stocks. Similarly, for the PB ratio. So, how will you create a trading strategy based on the value factor? So, let's see now. First, we'll actually prepare the data because you should look at good quality data before you move on to actually building a strategy. Once you have this data, you will move further and you'll calculate the PE and PB ratio. Once that is done, as we have mentioned before, you have to choose the stocks which have a lower P and PV ratio in comparison to others. So we'll rank these stocks in ascending order of the PE and PB ratio. Now, for the sake of illustration and for this strategy, we are assuming that both these ratios hold equal importance, and thus we will allocate the ranking equally to both of them. So that is why we will combine both the ranks and rank these stocks in ascending order. And you'll set the signal to 1, which means buy for the top 10 stocks. And finally, you will evaluate the performance metrics. Now, these performance metrics are not just the cumulative returns, but you actually look at the maximum drawdown, the Sharpe ratio, as well as the CAGR to make sure that all possible angles are covered. Great. Now, enough of the theory. Let's start and let's create the strategy and see how it performs. All right. So, this is where we are going to backtest and evaluate the performance of the strategy. So, what I'm going to do is I'm going to open the Python notebook in the course itself for factor investing concepts and strategies. And as you can see, this course covers a lot of concepts. It starts with understanding smart beta and explains what factors are. It even tells you how to retrieve fundamental data and price data from resources. So for this course, we have taken Symfin, but you can use any other resource which you have. And further, you will go through the four factors, which are value, momentum, You will also see how to combine value and momentum. And further, you have size as well as the quality factor as well. You'll see how you can build a strategy on these factors. And further, you'll also look at factor timing and how to identify the relevant factors and combining these factors together. And at the end, you'll also see how you can look at unknown factors as well. All right, so we'll start with our value-based strategy first, right? Now, for the sake of simplicity, in the course, we have divided the strategy into four notebooks. In the first notebook, we look at how you are going to calculate these financial ratios. Now, to make sure that we are within our time, I won't go through the code for the strategy line by line, but I will tell you a surface level of what we are going to do in the strategy. So first and foremost, obviously, you will import the relevant Python libraries. And since the data is for 100 stocks, or rather 100 companies of the S&P 500, we have used the pickle file to load this data. This data is stored in the BZ2 file, multi-factor data 2017 to 22, which we are using it in loaded data. And as I've said before, the formula for P ratio was given, which is price of asset upon earnings per share. Now, there are times when you won't actually find the earnings per share value directly. You'll have to calculate it. So the earnings per share formula is actually the net income of the company in that quarter, or if you're doing it on an annual basis for that year, minus the dividends which have been paid. And this sum will be divided by the number of outstanding shares to give you the earnings per share. And then to calculate the price to earnings ratio or P ratio, you will take the price of the asset or the close price if you want and divide it by the earnings per share value. So in this, first we will retrieve the relevant data which we need. So we have taken all of it. We have calculated the EPS first, and then we have calculated the P ratio as well. And we have printed the last 5 rows of the data set. So this is from 24th June 22 to 30th June. And you can see the P ratios of all the companies. And for the sake of brevity, some companies have been not shown over here. And right, so here, for example, Apple, which goes by the ticker AAPL, the company's P ratio is 81 and it is 95 on 30th June. So in this way, you have calculated the PE ratio. And further, you can calculate the PB ratio using the data which we have provided in the course as well. The formula for PB ratio is, as was mentioned before, price of asset upon the book value per share. And the book value per share is calculated by the total equity divided by the number of outstanding shares. So now you have calculated two ratios, which is the PE and PB ratio. In the next one, what we are going to do is we are going to identify the undervalued assets. So once you have the PE and PB ratio, what we are going to do is we will take a data frame called as rebalancing. Now, why we are doing this? To give you a gist, as you know that any strategy, any factor-based strategy tends to be on a long-term horizon. So you're not going to buy and sell every day, correct? So for the sake of illustration, we have decided that you can rebalance the portfolio every month, which is somewhat of a standard practice. You can also rebalance it on a quarter basis or even annually for that matter. That is done so that we can Uh, sorry. So that is done so that the transaction cost is not high. So in this strategy, we are actually going long on 10 stocks at a time. So if you do it daily, the transaction costs will add up and that might eat into your revenues. So that is why what we'll do is we'll do rebalancing every month. And the first thing which we need to do for that is you will check the first date of the month. So for that, you have taken the rebalancing data frame and the index is, or rather the date is the same as PE ratio. And you have, with this line of code, you have checked whether the date is the first day of the month. So, and then you have printed it. So as you can see over here, the is start of the month column will tell you whether the date is the start of the month or not. So here 2nd October is the first date. Now if you're wondering why it is 2nd October and not 1st October, this is because 2nd October is the first trading day of the month. Now further, you will create a function to sort the tickers according to the condition for sorting asset. So in this strategy, we are using the ratios PE and PV ratio, right? So we'll take the PE ratio and we will take the data for the start of the month and we'll store it in the start of month data frame. As you can see over here, the PE ratios for the companies has been stored over here, and this is every month. So for Apple, it was 53 on 2nd October 2017. This is the PE ratio, by the way. In 1st November, it is 58.4, and so on. So now that we have the PE ratio data on a monthly time scale, we can move ahead and we can rank these stocks. So remember that we are looking for stocks which have a low PE ratio. So we will use the rank method and we'll say that ascending parameter is true because we want the low P ratio to have the lower rank. So in that way, we have used the rank method to rank these assets and we have printed it. Now you can see over here that Apple has 53rd rank out of 100 for its PE ratio. And accordingly, Amazon has the 98th rank according to the PE ratio. So all these stocks have been ranked according to the PE ratio. Further, you'll use the same code to rank the stocks according to the PB ratio as well. So Apple has the 68th rank in terms of its PB ratio. Now, finally, you will create a data frame where you'll add the ranks of both the PE and PB ratio. So Apple had the rank 53 according to PE ratio and 68 according to PB ratio. So the total rank will be 121. Now that we have combined the ranks for both the PE ratio and PB ratio, we will move further and to identify the undervalued asset using these ratios, you will rank this total rank data frame. And you'll only keep the ranks for the stocks which have a rank between 1 to 10. This is just to make our lives easier since we are going long on the top 10 stocks. So once we have done this, you can see that most of the stocks have NAN values, right? And the stock which has the ticker MS has the fifth rank on 2nd October. So in this way, you have identified the top 10 undervalued assets using the value factor. Now in the next notebook, you're going to generate buy signals for these top 10 stocks. So in a Quantra portal, if you haven't seen it before, the notebooks are hosted on the Quantra portal directly, and you do not need to install anything for the code to run. You can simply like use kernel restart and run all, and this notebook will run on the portal itself. So now what we have done is we have taken the assets which have been ranked 1 to 10, which were stored in the total rank data frame. We have taken this total rank. We have also used the closed data as well. And now we are going to generate the signals to go long on these top 10 stocks. So till now, we were looking at the monthly time frame, and you have to move further to go to the daily time frame as well. But it is simple. If at the start of the month it was a buy signal, let's say for MS, it was a buy signal, you will actually be long on this stock for the entire month. So you just have to forward fill it for the entire month. So what we have done here is, since you're not bothered with the rank per se, you just know that you're going long on the top 10 stocks. It doesn't matter if it is the first rank or the eighth rank. So you're just replacing the ranks with one. Here, one indicates that we are going long on it or buying the stock. So that is what we did with this piece of code. And now there are cells which have NaN values, right? As you can see, you're not going long on Apple, right? So over here, what we do is we replace the NaN values, or not a number, as you call it in Python, with zero, which means that do not buy. So you use the fill any function, and once that is done, you can see that only the stocks which you're going long on have the buy signal, which is one. All others have the signal as zero. So this is how you have generated the buy or do not buy signals for the 100 stocks in your stock universe. Great. Now that you have all this, you are ready with the signals. Obviously, you'd be interested to know how the strategy performs, right? Correct. So in the next notebook, we will look at how this strategy is performing. So you took all this, you have taken the trading signals, and now you want to see how it is performing. You are using four metrics in all for this strategy. So you'll use a performance metrics data frame to store the relevant metrics which you have. And how are you going to calculate the returns? So it is simple. First, you take the percentage change of the close price data. And for any uh, for any asset, what you're going to do is, let's say you are at 1st August, all right, and you got a signal of 1, which is buy. Now this signal is generated at the almost at the end of the day. So we are assuming that you're buying the stock at 1st August close. So on 2nd August, whatever returns you are getting is your daily return for that day. And since you went long at the close price of the 1st August, you take the close price of these 2 days from 1st August close to 2nd August close. The difference you will multiply by the trading signal. So that is why you'll find that we are using the shift function. So if you got a trading signal of buy on 1st August, you shift it by 1, and then you multiply it with the daily return. So that will be the 2nd August. And this way you have calculated the returns. Now, in this strategy, you are going long on 10 stocks, right? And to make it simple for us, we are deciding that you're going to allocate your capital equally. So that is why you take the mean returns of it. And we are taking the mean returns of only the stocks which you are going long on. So that is why we have used the apply function and also the user generated function using lambda to take the mean of all the assets where the return is not equal to zero, so that we don't take into account Apple, which had a do not buy signal. So once you have the mean returns, you will calculate the cumulative returns, which is simple. You'll use the comprod function over here. So why we have added one to mean returns, that is just to have the returns start from one here. So this is how the strategy performance is for the backtesting period from 2017 to 2022. And so what this means is you have returns. If you had invested $1, this is the return you will get at the end of the backtesting period. Now, this does not mean that this is just this is not the only metric which you have. You will actually look at the CAGR as well, right? Which is the compound annual growth rate. The CAGR for this is 12%, which means that annually you are getting 12% returns. And the Sharpe ratio is 0.59. Here we have assumed the risk-free rate as zero to make it easier to calculate the Sharpe ratio. And the fact is that different geographies have different risk-free rates, right? So you can just simply plug in the risk-free rate which is applicable in your geography and you'll get the relevant Sharpe ratio. And here's the max drawdown. That means at one point, your strategy would have declined by this much percentage. Now, bear in mind that this is the strategy which hasn't been optimized. So if you can use stop loss, let's say if you had used a stop loss at 20, your drawdown would have been less and your returns would actually come out higher. But that is something for the another time. So yeah, this is how the factor-based investing strategy works, and this is how you can go about creating your own strategy. So yes, this is all for the session. And now that we have finished the session, we I will hand it over to you, Kshitij, for the next part.
Thank you so much for this wonderful session, Rekit. And I will now request everyone to put their questions in the questions panel. Meanwhile, I would also like to share a bit about our latest course, Factor Investing Concepts and Strategies. So, as we are launching this course just now, so we are offering a 75% discount on this course. And this offer is available to all the webinar attendees with some additional benefits. So for the next 4 hours, attendees of this webinar can avail this course at 7% higher discount on top of the launch offer, which is 75%, using the coupon code that is in front of your screen. And I have also shared the link and the code in the chat, so you can access that. And then uh, you can also avail another offer that is on any learning track on Quantra at additional 30% discount by using coupon code web70 plus 30. So I have also shared the same in the chat. The link is in the chat and coupon code is also shared. So please, if you are looking out to enroll in Quanta courses and explore more um trading strategies in a systematic manner. So make sure that you are availing these offers. Uh, Now, with that, we can start off with the Q&A. So, Rekit, there are a few questions which I have flagged already, and as and when we are going to get questions, I'm going to flag them so you can pick them one by one. And a lot of you have asked the questions repeatedly whether this webinar will be recorded and shared. Yes, it will be recorded and it will be shared also. And after this webinar, within the next 1 hour, you will get an email with a webinar recording link and also a link to these offers, which are available for a limited time. So, Rikit, we can start off with the Q&A now. Over to you.
All right, thanks, Kshitij. So far, I am not able to see the questions. Let me just check once again.
Yes, yes. Let me share the questions with you. Um,
Yes.
Now you should be, now you can see the questions.
Yes.
Can you?
So,
Great.
so one question asked is P ratio and PB ratio is same, which are in financial modeling and valuation. Is it equity research? Uh, yes, the P ratio and PB ratio, which you have learnt about, is the same which we are using over here as well. And that is the same as equity research as well. So, yeah, that is true. What is Sharpe ratio? So that has been answered, but in simple terms, Sharpe ratio tells you it is a metric to understand what the performance is of your strategy. Uh, Usually, they say a Sharpe ratio of more than one is decent. And let's see. So here's an interesting question. I am working on Python for finance, and should I also do C++ for softwares? I have an IT background and want to enter into quant trading. So usually for a retail trader, you are fine with using Python for trading, but if you also know C++, that is a good thing to have, that is a good skill to have. And rather, once you move into a space where it is more of on a minute level, and if you're going into high frequency trading strategies, uh, at that point, Python is not preferred. You actually look at other languages which are more faster in that manner. So, what do you mean by, there's another question. What do you mean by transaction cost in the rebalancing step? So this is an interesting question, and let me try to explain. So any stock which you buy or sell, apart from the share price, you have other cost as well. So this includes the brokerage. This will also have the securities, transaction tax, and other taxes as well. In some cases, there are some fees which are paid to the exchanges. All these can be clubbed together and which can be called as transaction cost. Now, think about it. If you have now these transaction costs are usually a percentage, right? So if you have just one stock, it might not be that high, right? So as a percentage of the price of that asset, you won't find that it is as high. But if you move further and if you're trying to buy 10 stocks at one point of time, these transaction costs sort of add up. Now, even if you say that, hey, like it is still $3 or $4, that is fine. You might say that. But if you think about it, and if you want to employ this strategy on a daily time scale, in which you might be just going long on three stocks as well. And mind you, when you're selling the stock as well, there are some costs as well. Correct. So all these costs sort of add up. And This is what I meant by the transaction cost in the rebalancing step. I hope that helps. Yes, you will get a recording of this video. And again, let's see if there's another question. Uh, do you share the Python codes for factor strategies? So this is a yes or no. In the course preview section, you can find certain codes which are available, uh, and you can look at that to get an understanding of the quality of the course. And you can, if it feels good, you can buy this course and you'll get access to all the Python codes for the course. So this is an interesting question. Uh, will it cover all types of algos as well as get online platform to build and test strategies? So the short answer is uh, not entirely. We have covered the most popular factors, and we have given you the Python code on how to backtest a strategy based on certain factors. You also have, you can also use this uh, understanding or knowledge to like log into your own broker terminal or or an API which is supported by a broker, and you can execute this strategy in a paper trading format as well. There are certain strategies which will work, which we have given the template to, and which you can try it out in a paper trading environment. And there's one question, why should we enroll in your course instead of those offered by our competitors? What makes your course better or different? Uh, I would have liked to explain why our courses are better than our competitors, but uh, I don't want to. You can simply go through the free preview of the course. You can see the content, and you can only decide if the course is worth your money or not. Ultimately, we are trying to equip the participants with knowledge about trading strategies, and we do not and we will never guarantee that these strategies will earn an X amount of profit or anything like that. Uh, that is how you're going to use it, and it is up to you on whether you find this course good or not. So, there's another question, combined ranking of PE and PB ratios. Is it the average? So, yes, you can take the average as well. For there are different ways to arrive at a destination, right? And uh, neither is right, neither is wrong. So you can use the average over here. I have used a simple sum of the ratios, considering that both PE and PB ratio should be low, and we are giving equal importance to both ratios. So whether you're using average, it seems fine, but you can use the average as well or the sum. So on there's an interesting question, how to make the factor trading strategy dynamic in order to avoid big drawdowns. So when you're coding the strategy, you can have a certain framework where you are going to check whether what the daily return is, and you can decide what threshold do you want, and if it crosses a certain threshold of stop loss, you can simply exit that trade to avoid it. Now, obviously, you would say that, hey, like if the asset has declined 20% in one day itself, and I'm checking on a daily time scale, that means uh, I've already lost 20% of my capital for it. Yes, you're right, but it is better to have a stop loss than to have none at all. That is what I believe. So yes, you can use a stop loss at that point of time. You you can also see what the backtesting performance is, and accordingly you can decide what stop loss you want, or rather if you want a stop loss or not. So that is up to you. But yeah, that is how you can have a factor trading strategy dynamic with stop loss so that you can avoid big drawdowns. And so this is an interesting question. Prices diverge from the book value per share. So does this mean markets are not rational? Uh, Interestingly, we have research from both sides of the coin over here. Some mention that markets are efficient. You call that the efficient market hypothesis. There are people who say that it is weakly, not strongly efficient. There are some who say that this is not rational at all. But you should understand the book value per share is a sort of historical metric, but sometimes people attribute future value as well when they are deciding, or rather, when they're deciding whether they want to buy a share or not. So, take the case of Tesla only, right? So, Tesla is not manufacturing cars at the level of industry heavyweights like Ford or GM, even Hyundai, but it still has a high price, right? High stock price. But there's a general belief, it might not be true, you never know, but there's a general belief that it is going to be the future, and they would, even though it might seem overpriced, they are happy to buy the stock of Tesla. So, to give you a short answer, markets may not look rational, but the stock price actually incorporates a lot of factors when the in its price. Right. So here's an interesting question. Is this course suitable for an individual who doesn't have knowledge of Python? Uh, See, knowledge of Python will be good for you, uh, as it will make your learning process easier. That being said, if you do not know Python, it is not a deal breaker. You can always enroll for courses which are on Python, learn Python first. That does not mean that take only Contra courses. You have a plethora of resources on the internet, on YouTube for that matter, even Stack Overflow. There are a lot of resources where you can learn Python for free, I might add. We have our own course, Python for Trading Basic, which you can go through. Our course is focused on the trading domain itself. But obviously, Python is used in a lot of industries, and you can use that knowledge too when it comes to creating your own trading strategy. So, yes, like learn about Python, and then you can take this course, or you can take this course and learn Python in parallel as well. So, one question is, I understand that this is a self-study course. Will there be support to clear doubts? So Contra is a portal where you it is a self-paced course, right, on Contra, where it is up to you when you want to study or not. Having said that, that does not mean that once you have bought the course, you won't hear from us at all. That is not true. We do have the community forum, which is quite active, I must add. And if there are any queries, the course participants can simply ask a question on the forum, and you'll find like-minded individuals answering that. We also have other people from the QuantInsti team as well, which will help you out if in case you have any doubt or any query with respect to the course material. So yeah, that is the And we have a question, or rather a statement. Golang is faster than C++. Just saying. Thanks. Yeah. And we have another question. So, can you use quant trading on DeFi or crypto trading platforms? What are the limitations for this? So, with respect to quant trading, now what is a quantitative trading, right? In simple terms, you are creating a model, and which in more simpler terms, you are basically having a hypothesis. You are creating the entry and exit rules based on certain uh, frameworks or statistical models, and then you're testing them on actual real world data and trying to understand whether it will give you a good performance or not. So, as long as the trading platform supports it, it is great. That is, you will have to do the research on that on an individual level, and you can, if there's support for live trading, with respect to creating a trading strategy in a programming language, then that is great. There'll be no limitation to you. But yes, you'll have to do your due diligence and make sure that it is a reliable platform and it is giving you a good service. So yeah, that is it. So here's an interesting question. My question is that can this model and codes on the course files be modified for creating portfolios in Indian markets? For example, to create multiple portfolios such as value or momentum portfolios. So yes, you can use this model, and you can use the code for in the Indian markets as well. Uh, as it is, we are not favoring any specific geography. If you have the data, then that is great. The limitation, not exactly limitation, the thing which you will have to watch out for is the data which you retrieve, in which format is it. So if the format is different, you might have to work a little bit to retrieve the relevant data which you need. So, for example, even an Indian company will report its quarterly earnings, right? This includes their income, this includes their earnings. You can calculate the earnings per share based on that data, and accordingly, you can put it in a format which is easier to read and which you can use to basically, in this case, calculate the P and PV ratio and further to create a strategy based on it.
Hey Rekit, we are running out of time.
Yes.
We are over 5 minutes from our scheduled time, so I would request you to
Okay.
pick one last questions. There's still some questions coming in, but I think we have a limited time, so at our end. So just one last question, and then we'll conclude the session.
Okay. So, yeah, one question is, could you list a few other factors similar to value? So, this is not, the answer would be not all of them are similar to value, but each factor has its own methodology and its own research done to identify whether it actually works or not. So the popular factors are, as I said before, value, quality, size, momentum. There are other factors as well. You can use actually volatility, even liquidity for that matter, to create a factor-based strategy also. All right, I think we have reached the end of our session.
Thank you so much, Rekit, for taking out your valuable time. and conducting such a wonderful session and answering so many questions. And I'm sure our audience has thoroughly enjoyed it. And to our audience, in case any of your questions went unanswered, I see that there are still a lot of questions which are unanswered due to the limited time. So we would love to connect and address all your questions individually. So please make sure that you share your questions and availability in the webinar survey right after this session ends, so that our team can connect with you and answer all your questions individually. And with that said, I would like to thank again everyone for joining us today, and a special thanks to Rekit again for conducting such a wonderful session. Uh, all of you guys have a great day ahead. Thank you so much.
All right. Thanks, Kshitij. And yes, have a good day or good evening, good night, depending on which part of the world you're in. And also have a happy weekend. All right. Bye.
Thank you, Rekit. Bye bye.